Hi everyone, welcome to the live stream. Looking forward as always to the session and to having a good discussion about what's going on in the market right now, and looking at some of the open positions that we have. With the Rebel Income System, having taken some assignments in the last week or so, hopefully as we get things rolling, feel free as well to share some of your thoughts and perspectives about uh, stocks you may be interested in, that you may be following. We'll probably have some time to do that as well. Really quickly, if you have a need in between these live streams, which happen each Friday, to contact me, you can do it a couple of different ways. The first is through email, and I'm putting that in the chat right now. My email address is rebelincomesystem@gmail.com. There we go. Ignore the first one. The second one is the one that applies. Uh, you can also reach out to me through the Discord server. If you've already joined that, then all you need to do is you can either message me directly through the direct messages feature, and just select me down under direct messages. You'll see me listed there, and you can do it that way. You can also drop a message in the open discussions channel. This is a channel I created just for members of the Rebel Income community, so that you can interact with each other as well as with me. And so that's the other area that I'd encourage you to take advantage of. A couple of other things just to keep in mind, if you're not totally familiar with Discord, think of Discord as just kind of its own really easy to use website. And what you see on the left hand side are the different channels that we use to make content available. Each Tuesday, you'll see me post the trading alert for the week for the Rebel Income trade that I'll be planning to make. You can see last week was on HRL. There was no trade this week. So Hormel Foods was the trade last week, and we'll check in on that one. There's also some other channels here that are available that you can check out. Monday, Wednesday, Friday, I post a report about a different stock from my watch list, running it through all of the criteria for the Rebel Income System. The articles areas where you'll see me post content more about the Rebel Income System itself, some of the different components and elements that I've put into building Rebel Income, and just to try to expand your understanding of how that works. Live webinar is where I put the link to this live stream each Thursday. So if you're not sure where to go to find that, that's where you'll see it. I will also post the link to this recording after the fact in the recordings channel as well. Okay, that's enough for housekeeping. Let's go ahead and move into and talk about what's going on in the market as we are wrapping up 2024 and starting to look at 2025. There's kind of a question that becomes pretty important to think about, and that's not just what has the market been doing, not just how have our investments done over the last year, but what else is new, and what else is coming up in the year ahead, and what kind of adjustments might be appropriate or necessary for the new year. Are there things about the investments that you made that in the last year or so that you feel like you need to change? Maybe they didn't work out as well as you thought that they would, or you learned that they just didn't fit what you wanted to do as well as you may have thought that they would originally. These are all, really good questions, and also completely fair to have. And so this is something that each of us need to make sure that we're doing on a regular basis, kind of revisiting what we've been doing and what's ahead. And so part of that for part of that in terms of drawing back and taking a broader look at things. Part of that is really about trying to see where the market is at right now. So let's start there. This is a chart of the S&P 500. As of yesterday, it was the week had been pretty solid. Again, a limited week considering the holiday, but we had oops. All right. Okay, we had pretty good rally up until the start of business today, and really things have reversed pretty strongly, and we're seeing some pretty good momentum to the downside right now. But we're actually not too far off of this historical high. This is the last all-time high, which came up at around 6,100 prior to the Christmas holiday. Um, And so part of what we're what part of the question at this stage should be really about whether or not that's something that is this does this mark a new reversal point? Are we at a peak that is really just not sustainable? This is there we go. Sorry. If we look back at the market over the last couple of years, we can see that we're following a really strong upward trend all the way since the beginning, since really late 2022, all the way up into the current day. So this is a 2-year upward trend that we're following, and we're starting to see things be very, very extended. So does that mean that right now what we're seeing is just the latest bounce along the upward trend where, you know, bounce, go higher, bounce, go higher, etc. Had several of these happen over the course of the last year. Is this just the latest one along those lines? Well, very possibly. I think that the market is very intent on trying to be as bullish as possible. It has for the entire year, even as indications like inflation have remained persistently high. Interest rates have started to come down, but there's been a lot of speculation about whether or not those rates should be coming down, and that that's something that adds some uncertainty as well. The fact that the market has been going up for on such a continuous basis for as long as it has is also something that translates to a market that is pretty extended itself. And you start to look at individualized stocks, and you're trying to find good value, such as those that we've got baked into the Rebel income system. They're not so easy to find, and so you kind of have to do a little bit more digging to find those. Now they're still out there. I don't take that as a bad thing necessarily. It just means that maybe you have to work a little bit harder. You have to be a little bit more selective. It's one of the temptations that people have in when the market is starting to really extend, and not just up. Let's talk if you're talking about a bear market that's been down for a long time and it just seems to be going even lower. A lot of the times, what you'll see people start doing is they'll make the mistake of thinking they need to change their rules to fit current market conditions. And I think that that's a big mistake. I think that what you do is you understand that different market conditions create different opportunities and limitations as these variations occur. And so, if I'm in a period where maybe it's a little bit harder to find the kind of value oriented opportunities that I'm looking for, that usually means that I just need to be patient and be willing to be selective. If I end up placing a few less trades during that period, then because I'm being more selective, that's wisdom, and that's okay. And so that's something that I think it doesn't necessarily mean that you have to change your rules. It just means that you kind of have to acknowledge the effect that the market may have on what you're doing right now. I think that if the market continues to push higher, we see it go and set a brand new all-time high here, maybe before the end of the year, or possibly early in the beginning of the new year, then there's going to be a temptation to say, okay, I'm going all in. The market's ready to go back and reassert itself to a whole new set of all-time highs. That may be true. Um, but I think that it's really about trying to stick to the system that you've built, that you've found success with. And so the idea here is not to get too worked up to the upside or the downside with any particular position that you're thinking about making. Okay, that's kind of the discussion of the broad market. If you have other ideas, please feel free to let me know. Let's go ahead and check in really quickly. Most of the open trades that I've been holding through most of the month expired before Christmas on the 20th. And so right now, the only open trade that I have, this isn't the only open position, but the only open trade that I have is on Hormel. We can take a look at some of these stocks that I've taken some recent assignments on and see where they sit right now. We'll have an opportunity to go through those. But for now, let's check in with Hormel. This is a put sale that I placed on the 18th, so a week before Christmas Day, selling the 32 strike price, bringing in about 70 cents. Oops, sorry, I missed a field on my trading log. It's a little over 2% on the overall premium, which was kind of nice. So let's go ahead and check in on that one. Here's Hormel sitting at about 31.74, still a couple of weeks to expiration, and sitting just a little bit below 32. So we have an interesting pattern going here where it's kind of just sitting on support at about 31.50, but not really going much above this 32 level. It's got about a 50-cent trading range right now, where for the last 5 or 6 days, it's just been hovering in that range. You can call that consolidation, and that would be correct for the last 5 days, but a tight range like this usually doesn't hold. So it could break down, possibly. And if it does, the question becomes, how far could it drop? By the same token, if it breaks above, the question is, where is going to be the next peak? So if we go and look back at some of the previous pivots that we've had below 31.50, we've got quite a bit of activity right here at around 31. So there's probably some pretty limited downside if the stock breaks down below 31.50. In the meantime, if it breaks up above 32, it's probably also got some limited upside. We've got both the 20-day moving average and the 200-day moving average, the green and blue lines here, both sitting at about a little bit above $32. Right around, we'll call it 32.50 for the sake of argument. So really, from the top of the stock's range for the last 5 days, there's only about 50 cents of upside. Now, if we break above this level, we get above 32.50, then we've probably got some upside to probably 33, possibly 33.75 up here at the top, where this pivot high occurred in the beginning of December. So that could be interesting. We'll see if we're able to get up to that range. But the way that this is right now, all things being equal with a couple of weeks to expiration, it does look like I could take an assignment on this, and that's okay. I don't try to avoid these assignments. In fact, whenever you see me place a trade here, I also always post a trading highlight. You will always see me make clear that the strike price that I'm selling is a strike price that I'm willing to own the stock at. And that's one of the really key rules when it comes to income generation, using put options as a way to as a gateway to stock ownership, is the way that I like to say it. One of the keys is that you should never sell a put option at a strike price where you're not willing to own the stock at. So if I'm selling 32, I am actively saying I would be willing to own the stock at $32. So let's see what that means. Right now, if you have placed this trade and you don't want to potentially accept an assignment, these are American style options. And that literally means that at any point, if the stock is below the strike price that I've sold, I could be assigned. I could be assigned right now. Stock's only about 25 cents away from that strike price, so that's unlikely. It's usually early assignments before the expiration date typically only happen if you really see a lot of momentum pick up for the stock against the put that you've sold. So if you see the stock really dropping several dollars below the strike price that you sold, then you're usually going to be more at risk of taking an early assignment. That's not the case here, but again, still, it could happen. So let's go ahead and take a look at the options here. And I am at the 17th is, I believe, the expiration that I sold. Yes. So 3 weeks to expiration. Here's the 17th, the $32 strike price. Remember, I brought in 70 cents on this one. And if I wanted to close this out right now, try to avoid the obligation, I'd have to pay 85 cents. That doesn't make a whole lot of sense right now, especially given the fact that there's still 3 weeks of time. I can go ahead and be patient and let that just kind of work itself out, and it should be fine. Doesn't mean that I won't take an assignment, but again, I just want to kind of give you an idea of what some of the alternatives are that you may be able to take a look at and evaluate. When you see a stock below the strike price that you sold, that's something that you should be taking a moment and evaluating and seeing if that's something that should trigger a decision or not. As it is, the stock is very close to the price that I've sold. As I mentioned, it's kind of consolidating here right now, and so I'm okay hanging on to it at this price. There is a good chance that it could break down again, but we've got a lot. We've really got a lot of. Wow, sorry about that. Keep switching to a different chart. We've got a lot of pivot activity between the stock's current price. Look at all of this in this neighborhood here from September through November, between 31.50 and 31. Got some here as well during the summer months. And so there should be quite a bit of activity here to give the stock some support. Okay. As I mentioned, that's the only open trade that I have right now. There were, from some of the stocks that expired last week, some assignments taken. And so let's go ahead and check in on those stocks and see where they sit today. We'll start first. We'll just kind of work down the list here. We'll start with Huntsman. This was a stock. I sold the $20 strike price, brought in 60 cents, and was assigned with the stock a little bit below that price. At 18.26 on the 20th. And that weakness is kind of has continued so far. Now we're, again. I got keyboard shortcuts that I'm used to, and they're not working right now. Sorry about that. So right now we're seeing this picking up some more bearish momentum, and it's even a little bit below the price that it was at when I was assigned on the 20th. So we'll see. It does look like there should be some pretty good support pretty close to the stock's current price. We'll see if it's able to hold up there, or if it continues to break down even further, which is a possibility. Again, just depending on what the market decides to do, especially with materials stocks in general. Though a lot of these have started to pick up some bearish momentum. That means there's really not a lot to do with this stock right now, as far as trying to place any new trades like a covered call, those kinds of things. I usually don't look for a covered call trade unless and until the stock has broken down, until the stock has moved back up to the price that I was assigned at. Now with Huntsman, being assigned at 20 for me was an opportunity to leverage leverage an existing position. A previous assignment I took at $34 when the stock was much higher. So my average price on this is actually around 27. So I'm quite a bit below that price now, but that's a little bit easier to digest than having been assigned down at 34. The next one that I took an assignment on here is Borg Warner. Took an assignment at 32.50 after selling a put sale that brought in a little over about 2.3% in premium at the time. Another company that I liked, like Huntsman, and that I've used in the past on a couple of different occasions. Now, it's assigned at 32.50, and the stock has stayed below that point. But there's also it's also actually pretty close to that assignment price, which means that there may be an opportunity here, possibly coming up on Monday, to sell a covered call on this and generate a little bit of extra income. So let's take a look. 21 days from expiration. Here we go. This is kind of interesting. So if I'm willing to work at the same strike price that I bought the stock at, and with Borg Warner, one of the caveats with this one is it's hard to bake in additional capital gains above the strike price that I've sold, unless the stock is actually pushed above that strike price. And one of the reasons for that is because of the way these strike price increments are built, at $2.50 each. That means you need to get some movement from the stock in order to possibly not only generate income from the covered call, but also add in the potential for some capital gain if you are called out. So with that in mind, really this it looks like selling the 32.50 covered call is pretty attractive, bringing in about 65 cents. That's 2% for the next 3 weeks. It does mean if I were to sell that covered call, that I would be actively accepting the fact that the bid price that I sell my covered call at is the maximum profit I will see. That's because I'm selling the same strike price that I was assigned the stock at. I actually do that quite a bit. It's not something that I'm afraid of doing. It doesn't bother me too much, but that is something that you have to think about and decide whether or not you're willing to do. If you're not, then you need to decide whether or not you just want to hold it and wait, or if you need to do something different. Some of the people in our group will go ahead and look out a little bit further and see an opportunity, for example, sell the 35 at 60 and to generate a little over 1.5% in that case for a 56-day trade. That's 2 months. So you're getting about, let's go ahead and just do the math here instead of trying to talk out the side of my mouth or off the top of my head. Remembering that I was assigned at 32.50. So about 1.84%. That's not horrible. However, that is over an almost 2-month period of time. So let's think about that on an annualized basis. If I divide 365 days by 56, that means that I'm only going to be able to place really 6 trades. So 1.84% times 6. It's about 11% on an annualized basis. That's not horrible, but we can do a lot better by working with closer expirations and using shorter time periods. This is why I talk a lot about trading frequency and why I'm a proponent of selling as little time as possible, even if it means that I'm giving up the potential for any capital gain. Remember that when you do something like sell out extra time so you can sell a higher strike price, this doesn't mean that you're going to get called out. You're basically selling the hope of being called out. And that's a little bit different in my book than what I can do with the 21 day trade, 3 weeks of time by selling the 32.50. Yes, that is the same price that I bought the stock at, but I can also pick up 65 cents more premium than what would be available at 35 for almost 2 months out. And I can increase my trading frequency potentially. If I am not called out of this, just to make sure here, okay, there's 2%, right? We can do 21, we've got 21 days between trades in this case, and that means being able to place 17 trades rather than 6. So higher trading frequency, 2% times 17 means 34% on an annualized basis. If I don't get called out, that potential is really attractive and certainly far better than the 11% that you would get by selling more time and hoping for some capital gain. Now, if you get the capital gain in that period of time, great, that's awesome. This is a matter to me of this is where I talk a lot about picking low-hanging fruit and picking up dimes and the money that is just kind of left in the street by the market. It's just waiting to be picked up. These shorter term premiums are really that low-hanging fruit. They're really just the money that is just waiting to be collected by income traders like ourselves. Now, that does mean that if I get called out at 32.50, I am saying categorically that I'm okay with that. That is something that is an acceptable result, and that's great. It doesn't bother me to be called out at the same price that I bought the stock at, because that frees up my capital. And if that's something that I've already built in the fact that premium is attractive enough for the time period that I'm selling. I can add that to the premium that I brought in when I sold my put option and combine those two to see what the overall return is in the overall position from the point of the put sale to the assignment and then the covered call to exercise, and see how that translates. And it's usually more than attractive enough. So we'll see if the stock continues to hold this pattern through the weekend. Obviously, there's not going to be any trading, but if we get into Monday, Tuesday, there may be an opportunity here to sell a covered call on Borg Warner. So here is my official notice that's going to be something I'm going to be paying attention to on Monday. And if it's still in a good position, I'll probably go ahead and place that trade and post an alert on the Discord server. Okay. The next position is Comcast. Now, this was a stock that I sold my put option on at $44. This was going back out of the group that expired on the 20th. This one expired on the 6th. And so I've held this one for a little bit longer, but I sold the $44 strike price. So it was about a 3-week trade at the time. Let's see where Comcast is now. Sitting at a little bit below $38. So I sold it at 44, while the stock was up quite a bit further. My strike price is up in this neighborhood. So the stock has picked up a lot of bearish momentum, especially right here in the early part of December, after I placed the put sale. Really saw a great big drop down below 40, and it's really just accelerated that momentum since then. So see if it can find a stabilization point and a place to start to recover a little bit. It's going to be a little bit of time before this comes back close enough to give me an opportunity for a new covered call trade. But that's okay. This is a company that I don't mind holding on to, and I'm willing to be patient and let this play out a little bit. It does pay a dividend, and so while I'm holding holding the position, I can just take in these dividends at a rate of 3.19% annualized. It's one of the reasons why I don't mind taking these assignments and potentially staying in them for an extended period of time. Even if I don't get a covered call opportunity, an opportunity to kind of pay myself my own dividends, I have these passive dividends coming in as well on a quarterly basis, and that helps as well. Okay, kind of trucking along. We may be wrapping up a little bit sooner than normal. Next one here is FMC. This is again a materials company. I was assigned on this one at $60, and I had a covered call. Sorry, that was actually supposed to be 80. Take a look at FMC. No, $60, that was right. Okay, I do need to update my spreadsheet though. $60 here. Sorry, folks. And $62.50. Okay, so I sold the $60 strike price, after which I had an opportunity to sell a covered call at the end of November at $62.50. That expired, but my original cost here is $60. The two premiums that I've sold here at $1.15 for the put sale and 90 cents for the covered call give me a total premium of a little bit over $2, which I can count against my overall cost. So against that $60 cost, puts me down a little bit below $58 for my net cost basis in FMC, and that's kind of nice, especially since the stock has kind of been following Huntsman and a lot of other material stocks lower lately. It's sitting at around 48.66 right now. And so that means that, again, this is going to need to pick up some momentum to get back to 60. That's going to take a little bit of time. So these are stocks that I may be holding again for a little bit of additional time. But again, now the dividend yield for FMC is even more attractive than for Comcast at 4.72%. And their next ex-dividend date is New Year's Eve. So I'll have that dividend, it looks like, probably coming up on the 16th of January. Since it's unlikely I'll have an opportunity to sell the stock at a profit prior to that date. So that'll be nice. That'll help too. I can also count that 58 cents against my net cost basis as well. All right. Nike, this was a stock that I was called out of. Check in on Devon Energy, DVN. This was a trade I was assigned in the beginning of November and have been able to use for a covered call here in mid-November that later expired. But for perspective, I was assigned at 39.50. And again, a lot of stocks are down here in some of these deep declines. This is kind of an interesting contrast to the broad market, isn't it? Where we see the market very near to some all-time highs. A lot of stocks, if you're discounting some of the, if you ignore some of the biggest stocks in the S&P 500 and tech stocks and so on, you see a lot of stocks that are down here at these lower levels that are offering some interesting values. And so a little bit of a disconnect between what we're seeing from the market indices versus a lot of the stocks that I've been following for some time on my watch list. That's actually a good thing because it makes it a little bit easier to find opportunities to generate income with put sales and with covered calls from these assignments. But it also means taking assignments. Oops. Sorry. It also means taking assignments when a stock does one of these where it's been going down and then all of a sudden that downward trend really accelerates and the slope of the trend also becomes much steeper. This is an acceleration of that downward trend. Hopefully this is a stabilization level. It looks like it has been for the last week or so. Hopefully it can use this as a level to consolidate and then hopefully begin to build some new bullish momentum. But that's going to be a matter of it's going to be a matter of time to see if that materializes. In the meantime, we are going to be sitting and waiting. This is one of the this is one of the things that you have to be willing to do when you're working with put sales. Is you are going to take some assignments. You're going to see these stocks sometimes drop significantly below the price you were assigned at and stay below for an extended period of time. All right, let's wrap up with these three: CVS, LRCX, and KHC. These were trades placed in October and that I've been holding for a little bit. LRCX had a good opportunity for a covered call here in December. That it did expire worthless, but let's start with CVS. I was assigned this stock at $64 and picked up a lot of momentum to the downside here in mid-December. It was starting to look pretty good and stabilizing pretty nicely through the early part of the month and the end of November, but then it really accelerated that downward momentum here. And hopefully, again, this stabilization level can lead to a new rebound higher. We'll have to see. That's certainly not doing it yet. So we'll have to see if that materializes. LRCX, I was assigned this one at $80 per share. So my assignment is up here. Close enough. With the stock down at about 72.83. So it has stabilized pretty nicely. at around 70 and built a little bit of bullish momentum, but still got some room to go to get to the price that I was assigned at $80. So again, playing a little bit of a waiting game while this consolidation starts to play out a little bit. That's not a bad pattern though. All right. And then the last one was KHC, which is currently at around 30.54. And on this one, I was assigned, I believe, at 34. Yep, $34. So again, we're quite a bit below this price. Stocks that I generally consider to be pretty conservative, like food products, some of these material stocks have been some of the ones that have seen the steepest declines lately. That's improved their value propositions, but it's also tested patience. So this is something where you have to decide whether or not you're going to be willing to let those play out and let them ride. You may or may not have the ability to do that, depending on what the how large the position size is that you're using. And yes, I'm beating the position sizing drum yet again, because it's important to keep in mind. I've shown you a number of stocks that I have taken assignments on over the past couple of months, and that are significantly below the strike prices that I was assigned. That's I'm not just It's not just about trying to show you the quote unquote warts of the system. This isn't really a wart. This is a characteristic of put selling. And sometimes you are going to take assignments. Sometimes you're going to take assignments on an increasing basis, and you're going to see those stocks stay below the strike prices that you sold. There's also periods of time where I see them rally and then move back above the price that I sold very, very quickly, and it works out great. Something like Nike, where I was assigned, and the next week I had an opportunity to sell the covered call. I got called out of the stock, boom, got my money back, got a little bit of premium, and even a little bit of capital gain as well. That's awesome when it happens, but there are also a fair number of cases where we have to exercise more patience. That's why I always come back to my fundamental analysis, my valuation, to decide if the prices that I'm working at, $34 in the case of KHC, is that a good value? If it is, that's really all I need to know. From there, the rest of it is really about being willing to exercise the patience to let things play out and understand that even though 34 may be a good price for KHC as a buyer of the stock, it doesn't mean that it couldn't go lower, that the market is still going to be the market and it's still going to be emotional, and that sometimes you have to be willing to let these play out over an extended period of time. That's kind of counterintuitive for a lot of people, especially if you're focusing on growth-oriented strategies. You're using trend trading or momentum or swing trading methods. You're usually operating with a much shorter kind of time frame and trying to take profits very, very quickly. With put selling, you're looking at something that requires a little bit more patience, a longer term view of things. That's why I say so often that this is an opportunity to take advantage of setting your own price for a stock that you like, and using put selling as as a way to potentially own that stock, as a gateway to stock ownership. Um, so as long as the price that you're selling is a price that you feel is a good price, yeah, the stock could still go below that price, but that's okay, because if the fundamental business is still strong and it's still worth more than the price that you bought the stock at some point the market's going to recognize that value, and you're going to see the stock come back to that point. It's happened over and over and over. You can look at my track record over the last 10 and a half years, and you see some stocks that I've held for a number of years that inevitably eventually came back, and I was able to get out of them. Excuse me. I was able to get out of them at either a higher price or at the price that I was assigned at. Have been a few losers, but very, very few. And so, on the whole, taking this approach, being patient, is something kind of taking a page from the Warren Buffetts and the Peter Lynch's, Benjamin Graham's of the world. These are proven strategies that have played themselves out multiple times across time, not just in the rebel income system over the last 10 and a half years, but over the course of decades. All right. Well, that's pretty much everything that I had for this session. I appreciate everybody's time and for taking the time to pay attention. And we can wrap it up here. I hope that if you're watching this live stream, if you're watching this as a recording after the fact, that you found this information helpful. As always, please feel free to reach out to me either through email rebelincomesystem@gmail.com or through the through the Discord server, and I will respond just as soon as I can. Thanks, everybody. Hope you've had a wonderful Christmas holiday, and that you continue to enjoy the holiday season. We will talk again. We will talk again next Friday. Thanks. Bye.